everyone. In this video, we're about to go over an exchange of non-monetary assets. And it will have commercial substance. So we're going to focus on the most important pieces of this analysis. First off, an exchange of non-monetary assets. What's going on? All right, so one company, in the example that I'm about to give, is exchanging a warehouse with another company. Okay, they're going to exchange assets. Well, why would they want to do that? Could be for any number of reasons. Maybe one company has a warehouse in New York and another company has a warehouse in California. Well, maybe both companies aren't using those particular warehouses as much as they would if they were in a different geographical location. So they talk it over with each other and they set up an exchange of non-monetary assets. What does non-monetary mean? It means quickly converted to cash. So they're going to be fixed assets that this is going to happen on. Most often, this is related to tax implications, but this is intermediate. We just need to know how to do the accounting for it, okay? All right, so let's look at the two companies. So the two companies in this problem are Denver Company and Bristol Company. You will be given the cost of the old asset. You'll be given the accumulated depreciation. You'll be given any information if they paid or received cash. In not every transaction they will pay or receive cash, but every transaction there'll be an old, and you're going to learn how you'll figure out the new asset. Okay, so let me step back, get this in your notes right now before we begin. The cost of the asset acquired. So this is the cost of basically the new asset, but here's the cost of the asset acquired equals the fair value, so the fair market value of the asset surrendered, okay, plus cash paid or minus cash received. So one party will be paying cash, one party will be receiving cash, okay? That's if cash is involved. All right, next thing I want you to get down is the gain or loss. A loss will be a negative, is going to equal the fair value of the asset surrendered minus the book value of the asset surrendered. Okay, so let's look at this problem. They gave us some information. All right, so here's what I have. All right, so right from your book, I am looking, they're making me look back at exercise 10.9. I see the cost of Denver's asset is 90. The accumulated depreciation is 55. However, I'm going over exercise 10.10. They changed one piece in exercise 10.10. Here's what it says. It says, use the same information as in 10.9, except that the warehouse owned by Denver has a fair value of $28,000. Okay, they did not change Bristol's fair value. So let's look at the problem for 10.9. Bristol still has a fair value of 30, okay? All right, so now let's go break this problem down. Okay, the first thing I'm going to show you how to complete is how to figure out book value of the asset. All right, so let's work on Denver Company first. All right, book value is always cost minus accumulated depreciation. So the cost of Denver's company's asset was $90,000. Their accumulated depreciation was $55,000. Subtract the two, 90 minus 55, and that gives you a book value of $35,000. Okay, so the book value of Denver's asset is $35,000. I'm going to teach it in pieces. Okay, the first thing I'm going to show you how to complete is the gain or loss on the transaction. All right, so let's go back up here. Let's work right from the notes, and then I'll erase it when I go over Bristol. Bristol is completely separate. All right, so the fair value of Denver Company's old asset, they changed it. They now said it was $28,000. That's the fair value of the asset surrendered. Minus the book value, I just went over how to compute the book value. The book value is $35,000. Well, guess what? This is not good. My fair value is less than my book value. I take the difference between the two, and that is $7,000. But that is a loss, okay? $7,000 loss. All right, now let me go back here. Let's do the new asset. So the new asset is the fair market value of the asset surrendered. So this will be $28,000 plus, remember I'm only doing Denver, plus what did Denver paid cash. So I am going to add that number, plus 2,000. So the new asset for Denver is 30. So I go over here. Here's where the 30 goes. So what do I call it? Building, warehouse, new. This is the new. And that is $30,000. Okay, next will just be accounting one information. I now need to take accumulated depreciation off the books. What's the normal balance as a credit? When I'm taking it off, I'm going to debit accumulated depreciation. My debit accumulated depreciation, $55,000. Okay, next, a loss has the same effect as an expense. A loss will be a debit. So I'm going to do loss on exchange. And that is $7,000. Okay, next I'm going to do the building, the old building, what's on the books right now, or the warehouse. And that is $90,000. And then Denver Company paid cash. Don't forget the cash. If you're not balancing out, you forgot the cash. In this case, they paid cash, so cash is a credit. Double check your entries when you're done. Your debits must equal your credits, because you can easily make a mistake in this if you're not paying attention. Okay, so I just went over Denver Company. Keep the companies separate or you will get confused, okay? All right, so let's go over Bristol Company next. Let's first figure out the book value of the old asset. All right, so I look at Bristol Company, all right? Their old building, the cost was $45,000. I'm going to subtract out the accumulated depreciation on the old asset, which was $25,000. And that's going to equal, so my book value equals $20,000, okay? All right, so everybody understands how to get that. All right, now I'm going to go up here. I'm going to erase this because I already showed you that. And I'm going to erase this because I already showed you that. All right, so this is surrendered, right? Okay, so now let's figure out the gain or loss first. Okay, so the gain or loss of the asset surrendered. So I'm going to take the fair market value of the asset surrendered. Remember, they did not change Bristol Company. So the fair value of Bristol was the same as what it was. And then I'm subtract out the book value. That's what we just figured. Here's the book value. Well, guess what? You've got your fair value is more than your book value. That is a gain. $10,000 gain. A gain is going to have the same effect as revenue, so that will be a credit. Okay, so just remember that. All right, so now let's go and let's put this problem together, okay? Let's first work on the new asset. Go back to the equation. How do you do it? You're going to take the fair market value of the asset surrendered, which in this case, this is Bristol, is $30,000. And then you will subtract any cash received, because remember, Bristol received cash, okay? So I'm going to leave a little space, I'll show you, because I got to do the cash first, but I want to show you how to do the new building or the warehouse. So one more time, how did we get this number? We took $30,000, the fair value of the asset, and they received cash, so you subtracted it, so that is $28,000. All right, now let's do the cash piece. I'm going to add that up here. They received $2,000, put that in. Okay, next, I'm going to take the accumulated depreciation off the books of the old asset. That was $25,000. Okay, then I have the building, the warehouse, and that is $45,000. Okay, I figured out my gain. A gain is a credit, gain on exchange, and that is $10,000. Remember, double check your math when you're done, because that's how you could easily, you might have forgotten the cash, that happens, so be careful. Double check your math, make sure they add up, and that's how you do it, okay? All right, get right in the software, and this particular problem, I'm not showing the answer, you had to watch the video to get the answer, all right? Get ready, we're almost done, you gotta start studying, the final's coming up soon, okay? Have a good week.